All right, welcome to On the Tape. This is the Monday edition. I am Dan Nathan. I am here with Liz Young. Guy Adami is on a well-deserved vacation. I know you're disappointed. You got in here and you didn't know it was going to happen that way,
did
you?
We've got two of the three. But
just you and me.
Did we do just the two of us last week on Market Call?
Yes, we did, and we're doing it again this week.
Wow.
Yeah, so Guy is on a quasi-vacation / business trip to sunny California.
Ooh.
Yeah, good for him.
Lovely.
You're well rested.
I am. And
I am not.
Over-caffeinated.
Are you? I'm under-caffeinated. I got in last night from Boston at 1:30 a.m. We were recording this today at 10:30 a.m. I did a lot of miles. I was up and back to Syracuse, New York from New York City in one day. I was up and back in the same day to Boston, all on the road same day. So
have you ever done a mileage run, what they call a mileage run, just to hit your status?
No. Oh, my God.
One year, I flew home for Christmas, and as everybody knows, home is Wisconsin.
Yeah.
I flew home for Christmas via Atlanta and Detroit.
Wow. You couldn't pay me to do that, but I get why you're doing that. All right, listen, you and I have a lot to cover because there's a bunch of earnings this week. There's a lot of economic data. We want to kind of really quickly touch on just some of the bank earnings from Friday. We had Schwab out this morning, some interesting stuff there. We want to talk about some consumer data points, a big surprise in Empire Manufacturing, which seems to fly in the face a little bit of some of the manufacturing data that we've seen. But Guy Adami left you guys with a really interesting conversation that he recorded on Friday afternoon with Tim McCourt. He is the head of financial and OTC products at CME Group. We had Terry Duffy, who is the CEO of CME Group, about a month ago in the immediate wake of this little regional banking crisis. We were talking about the duration mismatch, and he was saying, listen, if these guys had used futures to hedge out some of that interest rate risk, they might have been okay and not gone under, needed to get bailed out. So Tim McCourt joins Guy talking about some of those very products that could have been used for some of these banks to hedge out some of that interest rate risk. So that's a great conversation. Stick around for that. All right, Liz, let's talk about it. And I think we were really cautious on bank earnings, okay? Meaning cautious on getting too bared up on what the price action might be afterwards, considering just how poorly regional banks had traded and really not getting up off the mat. But then also in sympathy were the major money center banks. That's where, if you're looking at the XLF, it was down, 10, 11% or so in sympathy with the regionals. Life insurers were down, and we're saying the last couple of weeks, listen, not a great trade, not a great press on the short side. What was your takeaway by first what the banks had to say, what they reported? This is, and we know that Bank of America reports tomorrow morning, so that one's going to be in specific focus. But what was your take on what they said and then how the stocks reacted? Because, JP Morgan was up nearly 8%. It was just like a rocket.
Well, I mean, first of all, we've heard from some of the really big ones, and I think what's happening so far is that one group's loss is another group's gain. So some of this maybe isn't as surprising.
Which is what you did say last week into this, so good on you.
Well, thank you.
Yeah.
But I also said I would hold out and not necessarily trade the banks ahead of earnings. So far we've gotten good news. And here's the thing. We all know that investing is a sentiment-based sport, right? And we kicked off earnings season. There was all this anticipation that earnings season was going to kick off with the banks, and that was kind of the epicenter of the headlines. And it turned out to be a pretty good kickoff. So I think that's helping sentiment right now. It helped us not begin earnings season on a sour note. And I think it's good that we didn't hear a surprise downside from some of the big ones. However, if you look at the price action, so obviously the big names did well after surprising to the upside and, took in more deposits. Lending revenue was up. So a lot of that was good news. Perhaps, again, not surprising with higher rates. But if you look at the price action in regional banks, they obviously did not keep up with the big banks last week. Nope. So some of these cyclical indicators and the fact that we haven't heard from regionals yet, I still would wait this out. Now, is it a bad place to be? Is it a bad place to be in big banks? Not necessarily, but your holding period should be longer if that's the case.
Yeah, I mean, listen, JP Morgan up 8% in a straight line is not particularly helpful, I think, if you're trying to figure out. My take last week is like, listen, I wouldn't press him into the print. I'm not a buyer because I'm just not buying. I don't see the value right here given all the uncertainty. And really what this comes down to more importantly than anything is like, okay, so the price action near term discounted a lot of the bad news. But if we do have a slowing economy, right? If we do have a recession, we've been talking about, some of the lending that we've seen in consumer industrial loans. We've been talking about how there's going to be defaults in the commercial real estate. I mean, there's a lot of stuff that could be a massive headwind to bank earnings later on this year. So to me, that's why I'm not a buyer here. And I also thought that I'd be a seller if they're actually respond positively. Let's see what Goldman Sachs, Morgan Stanley, Bank of America have to say, and I think you'll have an opportunity. You mentioned the KRE, which is the Regional Banking Index. Right now, on the day, it's down. I mean, it's barely up off of these lows that it's been banging around. So again, it still feels like there's some stuff to happen there. I want to hit Schwab really quickly, Liz, because again, I don't think the estimates were worse than what a lot of analysts or investors were expecting. Estimates had been coming down over the last 5 or 6 weeks or so.
Yeah.
And if you think about the price action today, it opened down, reversed. It was just up 3%. It really feels like it's going to be meandering a little bit. But I think there was a couple really important takeaways here. I mean, the most important one to me is that given the uncertainty about regulatory, they're suspending their buyback. And that's something that we definitely did talk about over the last few weeks. If we were to see a lot of these companies kind of hint to that very thing, that is not supportive of valuations. Thoughts on that? Because that's probably the most important takeaway for me, other than the fundamental aspects of kind of just their lending and what's going on with deposits and net interest margins and the like.
Right. Well, so buybacks and dividends are a way. And I'm sweeping with a broad brush. I'm not saying that buybacks and dividends are bad. They are definitely good and they're shareholder friendly if you're in the stock.
Yep.
But in an era of economic headwinds and in an era where it's almost like we're losing another bull every day, right? They turn over bearish or at least become more cautious. Buybacks and dividends are what keep stock prices kind of elevated in almost an artificial way if the fundamentals aren't there to support it. So when you start seeing companies abandoning those programs because they're trying to make sure that they have enough capital, if that's the case, I don't have a direct line to Schwab's CEO, but if they're doing it because they're trying to preserve capital, or maybe they're doing it in concert with increasing loan loss reserves and being more conservative for the rest of the year, that tells you that especially in the financial sector, they're saying, all right, look, things could get worse before they could get better, and we want to make sure we're prepared. We know that this is maybe not the most shareholder-friendly move, but this is the best corporate governing move and the best kind of steward of capital move, and that's what we have to do. I don't think it's necessarily a bad thing for them to be prepared, and one of the things that we've talked about, especially with the big banks, is that given what happened in 08, 09, they came into this period more prepared than ever, right? Higher capital ratios, ready for whatever economic storm came their way. So I would expect them to be able to withstand it. But this is another signal that they're trying to make sure they're really ready.
Yeah, and that's the point, I think, about uncertain regulatory environment. Now, what do you do to raise capital ratios? You stop buying back your stock or paying dividends, that sort of thing. But a lot of people own those financial stocks. And I just want to make one point. There was an article in Bloomberg this morning talking about Apple and kind of saying the most important number when they report on May 4th might be their buyback. I mentioned last week on one of the pods that in last quarter, in the December quarter, they bought back $25 billion worth of stock. Last year, they bought back $90 billion. In the last decade, they have bought back $573 billion. That doesn't even include dividends that they paid back. But the interesting thing about this, and people ask about buybacks all the time, and you just mentioned this, I mean, you are massaging your earnings by doing that. You're basically saying that you think your stock is a better value than maybe the sort of CapEx that you could do, the sort of hiring that you might do, the sort of M&A that you might do with that capital. Now, what's changed a lot about the buyback scenario, especially with Apple, that has $165 billion in cash and generates a lot of cash, and they were able to borrow at nothing. They have about $111 billion in debt right now. With rates where they are, that picture has changed a little bit. So the idea that some of these big tech behemoths with huge cash balances, might they not keep up the pace of increases of buybacks, and therefore maybe that is downward pressure on earnings per share in a weakening economy? I don't know.
Yeah, well, the other thing that I think we have to keep in mind is remember the TARP program?
Yeah.
I hope we don't ever have to do that again. But back when that was put in place, companies got all of this money, they got all of this cash to use. The intention for all of that, and even QE back then, the intention was that they would use it to spend on CapEx. They would use it for M&A. They would use it for R&D, right, in order to grow the business and expand. And what a lot of them did was engage in buybacks and raising their dividend, which I'll say this, that is not a sustainable technique to create growth in an economy. You do need companies to continue investing. And if they're getting money from the government or wherever they're getting it from, you need them to use it, deploy it into growing the business, not just keeping the share price afloat.
Well, and again, one of the criticisms about Apple, and there's been political pressure, I think, on both sides, is that, listen, not that they've ever had a bailout or anything like that, but they've certainly benefited from low interest rates over the last, let's call it 10, 15 years or so. And a lot of their manufacturing obviously doesn't happen here. So that'll be an interesting one to track here. Let's talk about some retail sales data. I think there was an article in Bloomberg this weekend I thought was interesting. So U.S. retail sales declined for a second month on fuel and autos. The value of overall retail sales dropped 1% after an upwardly revised 0.2 decrease in February. So excluding gasoline and autos, sales fell 0.3%. So talk to me a little bit about the consumer here, because we've kind of highlighted over the last few weeks some data, definitely versus the SIV or the Silicon Valley Bank failure. We've seen lots of readings on the consumer weaken a little bit. Now, we also know that housing's been weak. We know that, unemployment, while, wages are still firm, you know what I mean? We're starting to see maybe some kind of, kinks in the armor a little bit there. And that would be the sort of thing that I think you'd really start having to get your antennas up about consumer spending if we were to see unemployment materially tick up maybe on its way to 4% or so.
Absolutely. So a couple things here. The unemployment rate, I think I've mentioned this before, but when the unemployment rate, the most recent reading, goes above the 12-month average, that's usually a recession signal. We are sitting right on top of it right now. So decision point will be the next month or 2 months, depending on how it moves. Retail sales came in on Friday, missed expectations, down 1% overall. And that's the second month in a row this year, as you mentioned, of a negative month-over-month retail number. I want to compare that to 2022. If you look at the first 6 months of 2022, positive every single month. Every month-over-month reading was positive. The last 6 months, so the second half of 2022, 4 of the 6 months were negative, and now we've already posted 2 negatives in 2023. That's an obvious shift. That's an obvious pullback in retail spending by the consumer. And one of the things that we've talked about a lot towards the end of last year and the beginning of this year is that you've got all of the spending that happened, whether that was pent-up demand or just a desire to get back out there and do stuff. All of the spending that picked up, along with credit card balances that picked up, the consumer stays strong as long as the labor market stays strong. And look, the consumer is still strong right now. They're still spending, right? We haven't hit necessarily contraction phase in that, but I think that this is telling. This is a definite pullback. When you see things like durable goods tick down, which we saw last month as well, it is an indication that the consumer is at least tightening up the purse strings a little bit and saying, maybe we just wait this out, or for whatever reason, feeling less confident in the fact that maybe if they quit their job, they find another job, or the raises that may be coming down the pike, right? I think there is a little bit of a break in confidence here where people are just hitting the pause button and saying, I want to wait this out and see what happens before I really commit to more spending.
Yeah, and not only that, I mean, listen, the stock market has been very strong over the last few weeks here. So you think about just kind of what consumer confidence is made up of, right? And you think about if people feel, generally pretty good about their job, they feel pretty good about inflation coming down, the stock market is up, that's the sort of thing. So if the market, that's the sort of thing that makes people feel pretty good. There's a couple other data points I think are really interesting on the consumer. So this was an article from Axios. And so this is speaking about the inflation and generally spending versus that in a marked deceleration. Sales were up 7.6% on a year-over-year basis at the start of 2023, but that has now fallen to 2.9%, below the rate of inflation during that span, meaning that in real terms, spending has declined. Okay, so this is just another way to think of it relative to inflation, because again, I think the markets have cheered the fact that inflationary readings are coming in, but they're still very elevated on a year-over-year basis. And when you put that versus like some of these spending numbers, it doesn't always kind of it doesn't line up particularly well, I guess.
Well, and the other thing about inflation, and check out my note from last week. I know I amazed Dan that I could write 800 words on just CPI.
It was amazing.
yes, it's moving down, but the biggest reason why it moved down last month was because of energy prices. So if oil prices go back up, if gas prices go back up, guess what? It's not going to move down anymore. And services inflation is still there. It's still sticky. Shelter is a huge component of that. That hasn't moved in price, despite the fact that mortgage applications have slowed and some of the data is coming in weak, but the prices haven't moved yet, because in order for the prices to move, you need the houses to change hands, and nobody's changing hands. Nobody wants to sell. It's just sort of frozen right now. So we're stuck at this elevated price level. So I say that because if you look at inflation just kind of broadly and paint with that broad brush and say, oh yeah, it's moving in the right direction, everything's fine, it's not in all the places. But one of the things that is positive, and I know there's another article that we were going to cover on this, one of the things that is positive is last month, the food prices finally went flat month over month. And that hadn't happened in a while. As we know, food prices had put a lot of pressure on consumers as well. Eggs being one of them, that was down a lot. I love eggs. I'm glad that it came down.
I think we covered your egg fetish last
every
week.
Day,
really?
At least. At least one.
Yuck. Yolks are like one of the most disgusting substances on the planet.
You know, I'm one of those
people. That
people.
and the inside of tomatoes.
Okay. Well, that I can get on board with. But I'm one of those people at a restaurant. I order an egg white omelet and then ask them to put the yolk back in.
Oh, that's disgusting. All right. Honestly, I just threw up in my mouth. Really quickly, but on that front about food prices. So this was the article in Axios that I thought was really interesting. Why not go out? ? Americans are spending more money at restaurants than on groceries, and the gap has been widening. People spent 20.7% more at restaurants than they spent on groceries in 2022, and that figure rose to 29.5% in the first 2 months of the year. I saw that data point. Okay, so consumers spend about $130 on dining out for every $100 they spent on groceries. That's just a little math there. So to me, what's interesting is that seems like a last ditch behavior by consumers. They're like, screw it. You know what I mean? Like going to the grocery store has stunk because like prices are at levels that I just could never imagine buying eggs or milk or whatever the heck it was. And they're like, let's just go out. And I just don't like, given what we just talked about, all the other consumer stuff, that makes me feel like something's about to turn, like something's got to give here.
Yeah, well, because that's not sustainable, right? And that's not how people generally live. I don't know what it looks like. I agree with you. Something probably has to turn, but I don't know what that looks like. I think in New York City, at least, we're a little bit different because people go out more often than not, and going to the grocery store is just kind of a pain in the butt, and things are so much more expensive here. But it would also be interesting to know exactly what kinds of restaurants they're going to. Is this like fine dining that's on uptick, or is this Chipotle that's on uptick, right? In which case, I think you can draw a few more conclusions. But I would agree that this is probably not a trend that stays in place. And at some point, people probably go back to the grocery store. And I don't know what that means for the services industry afterwards.
All right, let's talk a little bit about the markets here. On Friday, the VIX closed very near 17, which is a level that it had not seen since January of 2022, when the S&P 500 was basically at all-time highs at 4,800 or so. And if you look at the S&P where we are right now, it's at 4,132. Okay, so we're still a good bit from those all-time highs. But it's interesting to me that we also have the S&P approaching a level that it was right before the SIVB thing. It was, I don't know, we're probably 1.5% away from the early February highs. We're entering into earnings season. It seems to be complacency is very high. I think it helps that the bank set a pretty good tone. If we had had any real disasters there, and again, they're not done. I'd be surprised at this point if there's any big outlier. If it happens, it's going to be from Bank America tomorrow morning. But, I'm looking around here. I see crude oil back above 80, but I see the Dixie at 102. So the U.S. dollar index has round trip that. Some people may say, well, those things are kind of connected. We just saw Bitcoin and gold rallying to levels we hadn't seen in a very long time. Those are things that might get some market watchers' antennas up a little bit. Or is it just suggesting that the Fed is ready at their May 3rd meeting to pause, their interest rate hikes? And again, I don't think a pause is anything to cheer about. It does mean that they're done for now. That's the whole definition of a pause. You know what I mean?
Yeah.
But like, for instance, if inflation were to spike back up, if there was some geopolitical event that caused oil, food prices, supply chains, to get disrupted, the Fed's going to have to put on that inflation fighting hat again. So to me, I don't think that's anything that the S&P or investors should cheer about equity market valuations right now.
Yeah, I think the VIX is not sending good signals here. I think that it's sending mixed signals to investors at best. And when you've got a situation where big banks are doing well, but regional banks aren't doing well, small caps can't keep up, you've got gold making new highs, right? It just feels like there should be more consternation under the surface. And despite the fact that we've had a lot of up days in the S&P, the breadth under the surface, not great. So there's something that just is not quite hitting. There's something that's not connecting about those signals, and I'm disappointed with the VIX's ability to show it.
Yeah, no, and then here's one point that I just want to make about valuations here. So this is per FactSet. The forward 12-month PE ratio for the S&P 500 of 18.3 is below the 5-year average of only 18.5, but above the 10-year average of 17.3. So I guess what I'm saying here is like, or what they're just giving the data, but what I'm kind of interpreting this is like, okay, so X those 5 or 6 biggest names in the S&P 500, we know the equal weight S&P, I think it bottomed at like 14 times or whatever, but that's not how we do this, right? Because if you think about those 5 or 6 names, they're huge contributors to S&P 500 earnings, and they're trading very expensive at a time where interest rates are at their highest levels in a long time, at least Fed funds, right, is approaching that kind of 5% bound. I do think it's interesting that the 10-year U.S. Treasury yield is at 3.6%. That's going to continue to confound a lot of people here. And we still have a 2-year that is above 4% at basically 4.19%. So to me, the S&P 500, unless we are not going to have a recession in the next, let's call it 3 to 9 months or something like that, or at least it starts at some point, the S&P is really expensive because it is not discounting, right, the potential for lower S&P 500 earnings. And let's be clear, S&P 500 earnings are already in a recession. So thoughts on valuation here, Liz? And listen, this cannot be the only pillar of the bear case, people. Again, we reference it because these are usually good guideposts as you think about how markets bottom after, a difficult period or whatever. But we haven't even had a recession yet.
Yep. Okay, so I'm going to play through a thought process. If this is the case, if valuations have gone up this year because rates have come down, and that's supportive of tech valuations and growth in multiples across the S&P, then ask yourself, what does that mean for the rest of the year? Or what does that even mean for the next 12 months? Then you would say, all right, the bull case is rates continue to come down. The Fed eventually pauses. Maybe they start to cut rates in order to normalize policy. Then that's good for stocks. Well, why would the Fed cut rates before the end of this year? There is no reason they would cut rates before the end of this year unless there was some kind of stress in the system, economic data started to roll in weekly, or weak as in weak, or the labor market breaks, right? And as we know, once the unemployment rate starts to tick up, it flies up. It doesn't just slowly climb a hill, it flies up. So there is no good reason, like you said, that the Fed would cut rates this year. If they have to cut them, it's going to be for a bad reason. What happens to stocks in that scenario? They go down and valuations are not supported. You also have to think about if earnings are at best flat year over year, that's not supportive either, right? There's no real fundamental case to be here. And I know I've made this point before. If we're at 18.1, 18.2 forward earnings, look at the 10-year average of whatever it is, depending on what your data provider is. My data provider says 17.2 times is the 10-year average. That 10-year period was spent with a 10-year treasury just above 2%, and at least 5 of those 10 years were spent at zero Fed funds rate. So this level of valuations just does not make sense in the environment. It does not make sense for what we're seeing probably for the rest of the year.
So during that time period, also in the 10 years prior to the pandemic, the average GDP growth in the U.S. was about 2.2%. Okay, so think about that, all right? So and then the other point I'll just make, and I think, your point about rates is a really good one. If you take a chart of the 10-year U.S. Treasury yield and you go back to 1980 and you do a log chart and you draw a line from the upper left to the bottom right, okay? You get basically the breakout level was about 2.75% or so, okay? So what are normalized rates? To your point, if they want to normalize rates, usually they're focused on normalizing rates up, right? Like that's the world that we lived in back in 17, 18 when they started doing that a little bit. If they were to normalize rates in an inflationary environment like we are in, okay, like so I don't think inflation's going to go back to that 2% sort of like bound anytime soon. So there's going to be a higher effective rate, right? Because if inflation stays high, and that's the issue, I guess, that we've been talking about. Danny Moses has been talking about. Guy Adami's been talking about. What's the proper valuation in a stagflationary environment for the S&P 500? I don't believe it is 1 point above the 10-year average when yields were as low as they were and inflation was as low as it was. So that's one of the big issues. And listen, we catch a lot of heat. I don't care. I listen. We love hearing from you guys, the tweets, the DMs, the emails, all that sort of stuff. As somebody tweeted us today, well, you were right in 2022, but you've been wrong since the lows in the NASDAQ. Well, I listen, being wrong for the wrong reasons to me is like, that's a foul. Okay. Like being wrong for the right reasons. And again, we're not your hedge fund manager. We're not your mutual fund manager. We're not your, I'm not a strategist or anything. I'm just calling it the way I see it here. And to me, a lot of that doesn't make a whole heck of a lot of sense. I want to ask you about this. Carl Quintanilla, our friend from CNBC, he is an amazing follow on the Twitter. We say it again and again and again. He quote tweeted something from Tom Lee at Fundstrat, and I thought this was really interesting. We'll put it in the show notes. This is from Tom. The stock market is beginning to feel like a bull market as the percent of up days, and in quotes here, of the last 20 reached 65% last week, the highest figure since November 2021. Now, here's the thing, people. In the chart, you'll see that when I hear it's the highest, I'm trying to make a bullish case about the highest since November 2021. Well, that is the month that the NASDAQ topped out. Okay, and then dropped, close to 40% peak to trough, all right? And the S&P, topped out the first week of January 2022. What happened? The Fed said they're going to start battling inflation. They're going to start raising interest rates to do that. To me, I hear pieces of data like that, and I don't think that it's starting to feel like a bull market. I say to myself, it's starting to feel like a really complacent market, and we just went through some of the reasons why we think it's complacent. When you hear data points, and you look at a lot of data, and you put a lot of data into your reports that you have for your SoFi customers, that you tweet out, for your following, that you talk about on CNBC or our podcast here, you pick and choose. Some you choose to use and some you don't choose to use. When I see data like that, like I said, that doesn't seem like bullish to me. You know what I mean? Like, I'm just curious how you think about something like that.
Well, you want to see participation. So the way I think about it is how many stocks are participating in that? What other indices are participating in that? And the answer is not very many, right? The percent of stocks above their 200-day average in the S&P right now is only 60%. Usually you want to see that at least 80% or above to feel like there's broad participation in an up market. So think of it, if you want to make a sports analogy, something like the Yankees are good. If I make a statement that says the Yankees are good, are they, or is Aaron Judge just good, right? Are they still good without Aaron Judge?
Good. The Yankees are good.
Yeah, I know. That is, maybe it's a bad example. I'm doing it because Guy's not here, so in absentia, I get to pick on him. But if you take out some of the really big names that have been doing well and holding this up, is the S&P really in a bull market? Probably not, right? You wouldn't feel as confident making that statement. So it's about how many stocks are participating. And if so many people are invested in index-based ETFs, that matters. It really does, because especially if those big guys give some back or see some weakness, then everything goes down, right? And you hung your hat on the one or two strengths when we needed to really look at where the strength was under the surface. And this is a time where I think if you're going to make a statement or a call that we're in a bull market or that it's sustainable, it's only sustainable if most things are participating.
Yeah, and I'll just say this, and I said this on Friday's pod, and by the way, check out Fridays on the Tape. Guy, Danny, and myself, we had a great market conversation, but we had a fabulous conversation with a good friend of ours, Stephanie Rule. She is the host of the 11th Hour on MSNBC, and we covered a lot of stuff to a slightly different lens than we normally do. Steph was, started in her career as a banker for many years, and then became a financial journalist over at Bloomberg, and she was really, really good at it. And she's been doing general news at MSNBC, I think, for at least 5 or 6 years. And it was just interesting to hear kind of her take on a lot of this as she thinks about it through a slightly different lens, like I said, than we do. She thinks of it really more through Main Street than Wall Street, but she also has that other perspective. So that was really good. But also on that market conversation, we were talking about, again, just to kind of explain the complacency that what the VIX at 17-ish means to me. We have an S&P trading, like I said, about 4130 or so. Okay, so that means the SPY, the ETF that tracks it, is trading about 413. And when you think about that, and you think about all the earnings that we're going to have over the next couple of weeks, you think of the May 3rd Fed meeting, right? You think of the May 5th jobs report, where it's going to be really important also. So a ton of data between now and then. I look at what the market or what the options market is implying, and it's just too cheap. I mean, like literally, you can protect your portfolio between now and May 5th with all the things that we just talked about with an at-the-money put that is a little less than 2%. I mean, a little less than 2%. Now, you could say annualized. Well, that's not great. But what I'm talking about is 4 times a year we have earnings season. We've never had a meeting, I think a Fed meeting, as focused on, we got to go all the way back to March of 2022 when the Fed was going to do their first rate increase right now, right? Like, so when you think about it, this is going to be one widely thought about. So thoughts on just that last, like the idea that if you had a portfolio that maps very closely to the S&P 500, that you could protect it between now and May 5th for less than 2%. What does that mean to you?
Well, first of all, I would do it. Second of all, it means that I think there is complacency. Yeah. Also, something that, and then this is difficult to measure, but if the narrative that you're hearing doesn't match up with the action in the market, something's wrong, right? And my theme continues to be for 2023, somebody's wrong. Now, the narrative might be wrong. And like I mentioned earlier, we seem to lose one more bull every single day. Maybe the narrative has gotten too bearish. Yeah. Maybe now everybody is on that side.
That's a really good point. And that made me nervous late last year because obviously we were very bearish for most of the year. But then I started seeing a lot of strategists changing teams, and a lot of the strategists that we know are generally try to be very constructive no matter what the economic environment is or what some of the other things are telling us. So that made me a little nervous into year end. And then, again, I wasn't didn't want to short a rip-roaring market that made no sense in January. But then things started coming together in early February, and was feeling kind of right in mid-March. But then here we are, the S&P's up 8.5% in what feels like a straight line off of a lot of really bad news. But again, we say this, guys, again and gals, again and again and again. I mean, it's really hard to press lows, especially when sentiment is really bad. It doesn't feel that way right now. And especially if I look at this S&P chart, it looks good from a technical basis. We're about 1% or so away from those early Feb highs. But what is going to be the thing that breaks them out, right? Is it going to be a Fed pause? Is it going to be bad economic data that means that the Fed is likely to pause? That doesn't make a lot of sense for higher equity prices, in my opinion. So let's wait it out here. We got a lot of earnings this week, Liz, and I'm just curious if there's anything, if I throw out a few of these names, I know that you're not going to talk about them specifically, but tomorrow pre-opening, Bank of America is going to be important. Johnson & Johnson, maybe that's stock specific. Netflix after the close, that might be specific to streaming. Are there any names that are, Tesla's Wednesday after the close, very specific to EVs, but I think there's something there as it relates to China and as it relates to demand for higher price cars, that sort of thing. Taiwan Semi on Thursday might be really important. We talk about semis a lot. I know that you kind of are cautious there. Any of those sectors in particular that you really want to focus on with kind of most of the banks in the rearview mirror?
Yeah, so we're getting a couple airlines, right? We've got United and
not
American.
Good last week. What we had last, we had American and Delta last week. Not great.
Right. So I would watch the airlines because there is indication that consumers have pulled back on spending for travel. So watch those. They should have had a tailwind with lower energy prices, but if they haven't been able to make up with volume, that's an indication that things are pulling back. As tech starts, and this is not a big week for tech, but as tech starts to report, and we'll talk about this as earnings season drags on, that's what I'm focused on this time because we know that tech companies cut a lot. We know that they cut employees. We know that they cut costs. We heard all the headlines, and then we didn't see it come through in the economic data. This is the first quarter where we're going to find out if they cut enough. If they cut enough to preserve their margin. So as we start to see tech companies trickle in, I'll be watching those pretty closely, not just for what actually happened, but for their forward guidance. All
right. And the last thing before we get out of here, because again, it's earnings season, a lot of people ask us, what are some of the resources that we use when we think about, earnings and how do we evaluate different setups, that sort of thing. Obviously, we quote FactSet a lot. They're a great partner of ours, and they have a great Twitter feed at FactSet. at and a lot of the data that they're putting out there about valuations or certain sector stuff they put out there. So check that out. Another couple apps here, Liz. I don't know if you've checked these out. And again, I don't know either one of these companies, but I've seen them on Twitter. One is the Quarter app. It's at QUARTR_APP. That's really good. They do like these great summaries of some of the most important data points that they see in earnings calls. And the other one is at the transcript _. That one's really good too. So like all those apps, I think, listen, earnings season, it comes at you like a fire hose here, and it's like figuring out a couple little hacks, I guess, are really important here. So those are three that I've been using more. Anything that you like to kind of think about here a little bit? You can follow Liz on Twitter at Liz Young Strat People, right?
Yeah. I mean, I love Butters stuff.
Yeah, Butters is great.
I read his stuff all the time.
Well, and then the last thing, listen, we're going to be covering a lot of these names on Market Call. Liz is going to be back with me on Thursday. Today, if you're listening to this, maybe ASAP, I don't know, we're going to do, and we'll probably tweet it out here a little bit, how to figure out implied moves in the options market. So that's really important. Liz just talked about sentiment and expectations. Sometimes it's really helpful to say, oh, well, the options market is implying a 7% move in Tesla Wednesday after the close. That's a one-day move. On average, it's moved about X%. Maybe it's only moved about 3% on average. Well, why would the market with low levels of volatility be implying a much higher move? So then it makes sense to dig into what are some of the fundamental issues here? Why might, they've been cutting prices. That's how I think about implied moves. So we're going to be covering implied moves on the Market Call. So be sure to follow us on our YouTube page. I guess it's our Risk Reversal Media YouTube page. That's where we do the Market Call. Liz, you're going to be back with me on Thursday. I got Carter a couple times this week. Really appreciate all your help here, people. Stick around because Guy Adami had a great conversation with Tim McCourt. He is at the CME Group. He is the head of financial and OTC products here. So thanks for being with us. Thanks, Liz.
Thank you. Happy Monday.
Thanks.